Yo, what's up, guys? I have an interesting video for you today because I saw this article from Morningstar where they mentioned 5 undervalued stocks to buy right now. And this was published on October 7th, so literally just a couple of days ago. And all these stocks on the list do pay a dividend. So all these are actual dividend stocks, which is pretty cool. And actually, 2 out of the 5 stocks that they mentioned, I actually own and I have some exposure to. So I might be a little biased on those 2 stocks. But anyway, we're going to be looking into all these dividend stocks, be seeing for ourselves, are they actually a buy? We're going to be doing our own little analysis on them. So if you like this kind of stuff, don't forget to drop a like on the video. And let's go ahead and get straight into the first stock. So the first stock they actually mentioned in this article is ticker symbol GOOG or Google. And here's why some people may not like them. It's because their dividend yield is super low. But I want to show you a fun fact about this company. So Google will just round this up to a 0.5% dividend yield. And look at their payout ratio. It's a 3% right now. And look at their forward payout ratio. It's a 10%. And I'll show you the math on this a little later. But look at this. So Apple actually has a lower dividend yield. So they have a 0.44% dividend yield, and they have a much higher payout ratio. Look at the forward payout ratio. It's a 14%, and Google's is literally a 10% forward payout ratio. So that's pretty cool. And here's some other really cool stats about this company. If we actually look at their PE ratio, look at their forward PE ratio. If you notice, if you look right here, so here's 2021, here's 2020, here's March of 2020. So this was, the COVID pandemic. They're actually trading at the same forward PE ratio as this major dip in 2020. So this is kind of how, in my opinion, how much Google was actually undervalued. So even though you have a super low dividend yield, I think there's going to be a lot of growth to this company. I mean, I think they could go back to a 23 forward PE ratio, and that would send the stock closer to, $200 a share. But here's what's another really cool part about this company. So here's the earnings payout ratio. Obviously, they just started paying out a dividend, so really no point in looking at this. But look at their earnings per share growth. Look, in the next 12 months, it's expected to be $8.05. So let's actually do a multiple on this. So $8.05, let's do a 22 times multiple on this. That's actually, I think, very fair for an insanely high tech stock like Google. So that's $177 share price. If we look at Google right now, so this is the stock that I do own. I own some Google. It's at $164 right here on what I think is a very fair, if not undervalued, 22 times multiple. So we have an average cost of 163. We're actually barely green on our Google shares, but I really think that this one's going to be a great long-term hold. I mean, in 5 years, I think, it's a no-brainer. So we can also see their free cash flow per share. Their free cash flow is a little bit lower than their net income because they're investing heavily in the future in CapEx. So it's actually okay that their free cash flow per share is a little lower than their earnings per share. That's totally normal. And here's another crazy part about Google. They're doing insane share buybacks. Look at their shares outstanding in billions. In 2014, it was 13 billion. In 2014, now in 2023, or I guess last 12 months right now, it's at 12.6. So literally it's the lowest basically it's ever been thanks to their share buybacks. So we can see their total sales growth, very impressive. Return on equity, return on invested capital is at an all-time high. It's at 31% in the trailing 12 months. So all these different factors lead me to believe that Google is such a great buy, in my opinion. Remember, none of this is financial advice, but I think that's a great, I would say that they're undervalued, especially when we look at their PE ratio. It's where it was in 2020, the pandemic PE ratio. So anyway, that's what's crazy about Google. Let me know your thoughts on this one in the comments. Obviously, it's kind of like a no-brainer. It's one of the Magnificent Seven, but this next stock right here might be a little bit more interesting because this is ticker symbol VZ or Verizon. And let's actually look at this on Simply Safe Dividend. Let's see what they rate this. So they actually do give this one a pretty safe dividend score of 70, and they actually have a really high yield of 6.3%. So that's a very high dividend yield in my opinion. So let's actually look into their financials because we do need to look at this. Since they have such a high payout or a high dividend yield, they're going to have a pretty high payout ratio of 58%, but actually 58% isn't crazy. That's actually pretty fair. And, their net debt to EBITDA. So the telecom companies do have a lot of debt. That's the one downside about these telecommunication stocks like Verizon. They do have a lot of debt. So it says this is edging higher for the telecom sector, I guess. Net debt to capital, though, is 65%. They say that's high. I like how they compare it to the industry. So I guess that seems a little bit high. But let's actually go ahead and look at their numbers. We can see that their dividend, they raise it every single year. And they say it looks reasonably valued right now. So according to Simply Safe Dividend, Verizon is a pretty reasonable buy. So here's their dividend yield. It's above their average 5-year yield of 5% in the forward PE ratio. So wow, I actually didn't know this. Verizon is trading at a forward PE ratio of 9.2. And wow, look at this. In 2023, it was down here at a 7. They were trading at 7 times forward PE ratio. That's a crazy low valuation, but also how much more growth is expected with Verizon. Anyway, point being, this is still a pretty low, pretty fair, you know, PE ratio, especially when you compare it to the market. So here's the earnings per share growth. It's expected to not grow much over the next couple of years. This is why I don't love this. I mean, they've kind of been, it was 471 back in 2018, and they're not even going to make that next year. So that's a little bit, I don't love that. So where's the growth story in the future? Here's the free cash flow per share, though. This is actually looking good. 469. That's the highest it's been, I guess, since 2020. So that's a good sign. And that's a few stats about this. I want to show you their debt real quick. All right, so check this out. Here's Verizon stock. I want to show you their financials really quickly. So look at their net income in the most recent quarter. They made $4.7 billion. So that's actually pretty good. If we round that up to $5 billion, well, they did lose, $2.57 billion that one random quarter, but we're just going to ignore that for the time being. So let's assume they make $5 billion every quarter. That's $20 billion a year of net income. And if we actually see how much their dividend cost, their dividend only cost $2.8 billion. So like I said, that's around that 60% payout ratio, which is decent right now. But here's the one part you do gotta know about Verizon. They have $149 billion of total debt, but they do make $20 billion a year, so that might take a while to pay off. But we can also see they only have $2.43 billion of cash, and the company actually does not do any stock buybacks. So if you go to their total common shares outstanding, you've actually barely been diluted, just 0.13%. But point is, they're not diluting you, but they're not buying back any shares either. So I mean, hey, maybe they could do some share buybacks, but they did lose $2.5 billion in that one quarter. I'm not sure why. And we'll look at a few more metrics here. Look at the return on equity. This trend isn't great. And same with return on invested capital and their margins. So anyway, that's Verizon. I think that they're a good dividend stock, but not a long-term growth story. So this next stock is actually one I own in my buy and never sell account. So this is Nike stock, ticker symbol NKE. We'll quickly look at it on Simply Safe Dividend. They have a dividend safety score of 99, so nearly 100. They literally say there's no chance that this dividend is going to get cut at all. So let me show you this in my Moomoo account. So this is my portfolio where once I buy a stock in here, as you know, I can never sell it for the rest of my life. And we're finally up $1,500 total position profit and loss. So that's pretty cool. And here is Nike stock. We actually own 11 shares of this company and we're down 6% on them. And of course, I can never sell it for the rest of my life. You can see exactly where I bought all my shares in here. And if you want to download this app, I like having multiple portfolios. You can download it with the affiliate link in the description, so that would help me out a lot. But look at Nike's historical PE ratio. We can see right now they're trading at 23 times earnings. Way back in look at this in 2020, they were trading at 60 times earnings plus. And today they're trading at 23 times earnings, but that's because the growth has slowly went away. They're seeing some trouble in China. And if we look at their total market, United States is only 38% of that. If we look at Greater China, that's 14%. They also own Converse. That's another brand that they own. That's about 4% of Nike's total revenue. So that could be another growth story, growth segment. If we actually look at their EPS estimates from S&P Global, they did beat their EPS estimate and they just got a new CEO. So that was some really good news. But if we do look at their numbers, so this wasn't great. Year over year, their top line revenue declined 10.43%. If you look at their operating profit, it was down 24%, basically same as net income. Or wow, no, net income was down even worse to down 27% to $1 billion in the most recent quarter. So, I can admit that that's not great, but I still really like their financial condition. So if we look at Nike stock here, they definitely are on a downtrend and could be undervalued, but I want to show you this number right here. Here's why I think Simply Safe Dividend still keeps them at a 99, safety score for their dividend. So they made $1 billion in the most recent quarter. Let's not give them the benefit of the doubt here because, last quarter they made $1.5 billion and their total cash paid dividend, it's only $558 million. And if you look at it from the quarters before this, it's actually down. 2 quarters ago, it cost $562 million. Why did the cost go down so much? That's actually because Nike is spending an insane amount of money buying back their own stock. So on top of the $500 million they spent on dividends, they spent $1 billion buying back their own stock at what I think is a pretty undervalued price. If we look at their total common shares outstanding, so you now actually own 2.17% more of the company than you did 1 year ago. Same with their, where's their diluted weighted average shares? Yeah, according to this, you actually really own 2.68% more of the company than you do 1 year ago. So those are all some really good signs. And also Nike has more cash than debt. So look at their total debt. It's $9 billion. So they have $9 billion in total debt. And they have cash on hand right now of $8.48 billion after doing the stock buybacks and the dividends. So $8.48 billion plus, this is why they have more cash than debt, plus their short-term investments of $1.8 billion. So that puts them around $11 billion of cash. Short-term investments are investing in the 1 to 3 week treasury bills, short-term investments where they can actually buy the T-bills and get a little yield on their cash. So that's pretty cool. So that's why I also think Nike's at a very undervalued price, in my opinion. Let's actually go see more of what Simply Safe Dividends has to say about Nike. So here's Nike stock. They're actually at the highest dividend yield they've been in a very long time. Their 5-year average is well below this. So 1.8% dividend yield right now, nearly a 2% yield. And check this out. Their payout ratio is a 40%. Forward payout ratio is a 51%. So it went up right here because they are expected to they have lower EPS year over year adjustments, but that's really all right. Net debt to EBITDA is only 0.27 net debt to capital. So this is very good, very low for most companies. So that's a really great sign. Look at their annual dividends per share. It doesn't get any better than this. Right now, it's nearly at $1.50. Just in 2020, it was under $1. So it went from $1 to nearly now $1.50. So Nike does have a lot of dividend growth, and they're actually expected to raise their dividend next quarter. I wonder what they're going to raise it to. I'm going to just guess 40 cents, or maybe they'll be more conservative because they are in a bit of a downtrend right now, and the yield is well above its 5-year average of 1.07%. And like I said, look at their PE ratio. It seems pretty undervalued right now. Their forward PE ratio is a 28.5, well below their 5-year average. So that may be why they consider this stock undervalued because of that. And we can see their earnings payout ratio. It's supposed to go up because their EPS is expected to go down. So I actually think that they might not actually go down that much. That's kind of my bull thesis behind them. I don't know if that's for sure. They have the new CEO change. There is some risk here, and I'm probably going to be a little biased because I own the company, but at the same time, they're profitable, more cash than debt, and they're buying back their own stock like crazy. Look at this. Shares outstanding is the lowest it's been, ever, even since 2015. So the lowest amount of shares ever, and the sales, it is on a slight uptrend, but, it's down from 2023. We'll see what happens in the future. Return on equity, return on invested capital. So, yeah, that's why I like Nike. I also own them in my buy and never sell portfolio. Could be a little biased, but yeah. All right, so those were the first 3 dividend stocks. Don't forget to drop a like on the video. It would really help me out a lot. And let's get to the 4th stock. So this one might be a little more sketchy. So this is ticker symbol DOW, and it's not talking about the Dow Jones Index. This is talking about ticker symbol Dow, DOW. And they're a pretty big company, a $37 billion company. Most people probably have heard about them, and they have a pretty high dividend yield. So it's attracting a lot of investors through their yield, but there's something a lot of people are looking over about this company. They're also trading at 20 times forward PE ratio. So look, they have a 5% dividend yield, but look at their dividend safety score. It's a 45, which isn't great. And this is what they just said right here. So they just had this note right here on September. Oh, wait, so this was in 2022. So actually, this is really old news. I was going to mention this news, but they issued third quarter cash flow guidance, fell short of the analyst by 25%. So this is actually a really old score. So we can almost, okay, no, it was reaffirmed on August 9th. All right, this is getting out of the place, but they say there's a moderate risk of a dividend cut, and here is why. So look at this. They have a payout ratio of 130% and a forward payout ratio of 106%. So that's not great. And all these it's saying very high, and this one's edging high and edging high. Their debt obligations right now, and they actually just started paying their dividend back in 2018. They raised it, and then they've just kept it flat right here. Maybe they rose it too much, who knows? But here's why some people might get trapped into this company, because look, the dividend yield's 5% and the PE ratio is a 20. Well, actually, if we look at their 5-year average, they're actually trading at above average 5-year forward PE ratio, but still a 20 PE ratio isn't crazy expensive. But look at their payout ratio. Here's what's concerning, that they're literally spending basically all their money that they make on dividends. Like, how else are they going to invest in the future when they're spending all their money on dividends? That's how they sustain that 5% plus dividend yield. So the next 12 months, they're expected to have a 106% payout ratio, and the next 12 months of free cash flow. So this is their next 12 months of net income. Here's their next 12 months of free cash flow is 122%. We can see that their free cash flow per share is fallen. So wow, look at this. This is probably when they issued their dividend. They were making, $7 a quarter, or I mean a year. That's a lot of money. Hopefully we can get back to that for this company. And same with their EPS. Look at that. They were making $8, $6, but now I don't know what happened in the few most recent quarters, but they can't sustain that dividend anymore because the earnings aren't keeping up with it. So whatever caused this boom right here, maybe it was just the inflation that gave them excuses to raise prices or whatever, because they're kind of a commodity-based stock, right? Because if we look at what they do, they're in the materials, commodity chemicals, materials. So yeah, the commodity sector benefits from inflation. So maybe if inflation does come back, which honestly, inflation isn't looking like it's coming back, but it could. And, that would help out this company. But we won't spend too much more time on this one because this one looks risky. And honestly, I'm not going to recommend it. But it actually looks like they are doing a little bit of share buybacks. Look at that. It was 726. Now it's 706. So I will give them credit for that. Total sales, 43 billion. Yeah. Return on invested capital is below average. It was crazy up here in 21, 22. Crazy return on equity. But now, whatever happened, maybe they can get back to that one day. But for right now, I would probably stay away from this stock. And let's get to the final dividend stock on this list. So this is ticker symbol FMC. And I actually really haven't heard of this company and haven't looked at it before, but look at their dividend yield. They have a nearly 4% dividend yield, but they have a dividend safety score according to Simply Safe Dividends of a 50. And this is another one that's kind of in the chemicals commodity sector. They actually do fertilizers and agricultural chemicals, kind of in the material sector. So another one in a similar sector, but they have a smaller dividend yield of a $7.5 billion market cap. Still a pretty big company. So let's actually see what their financials are looking at and look at their annual dividends per share. So this one actually I like more than the last stock because they have a huge track record of raising their dividends, and it was flat right here for a few years. So yeah, so look at that. That stopped their dividend growth streak. So they only have 6 years of dividend growth, but still a really high dividend yield. Okay, so yeah, look at that. It stayed at 58 cents since January of 2023. Or wait, oh, I thought this company paid monthly. They do not pay monthly. So anyway, let's see what their PE ratio is. So here's their PE ratio. They're trading at 15 times earnings, which is probably reasonable for a commodity stock. And look at their dividend yield. It's well above the 5-year average. They cranked it up because they keep raising their dividend. We just saw their annual dividends per share. They keep on raising it, and now they don't need to raise their dividend anymore. That's probably why they're keeping their dividend flat right here. They're like, well, we're happy with this 3.8% dividend yield, and the valuation isn't nuts. It's slightly below their 5-year average. So, that's pretty cool. But here's the part that might not be great. So here's their earnings payout ratio. So last 12 months, it was a 93%, but the next 12 months, it's 56%. So that's actually a decent sign, actually. A 56% payout ratio isn't crazy, especially when we're talking about a 4% dividend yielding stock. We're actually going to go on Webull and look at their numbers so you can look at them for yourself in a second here. But yeah, here's their free cash flow payout ratio, 56%. Again, 56%. It seems reasonable. Nothing, too concerning there. Here's their earnings per share, $4.17. And shares outstanding. So it looks like they are doing the tiniest bit of share buybacks as well. Hey, I'll take share buybacks over, diluting you as a shareholder. So it was 126. Now it's 125. Looks like they buy back, a couple million every single quarter. Hey, look at the return on equity though. Looks like it's the highest it's been in a long time, but their return on invested capital is kind of fallen. Anyway, let's actually look at their numbers on Webull. So this is the final stock, So yeah, here's this stock right here. So this probably explains why the dividend yield has gone up so much, is because the company has fallen in stock price quite a bit. But remember, their forward payout ratio seems pretty reasonable. So let's actually see how much they make every single quarter. So look, they used to be very consistent back here, but now it's a little bit choppy. I mean, they did make $1 billion in one quarter, so I'm not even too sure how I should, what number I should use on this. So let's just go with their most recent quarter of $300 million in the most recent quarter. So let's assume they just make $300 million every quarter. Their dividend cost $72 million a quarter. So, they did make $1 billion. I don't know if that's real or not, but that makes their dividend payout ratio very, very low. If that's true, here's their diluted normalized EPS. Yeah, it looks very strange because of it's not as consistent as it used to be. But if that $11 is real, I mean, hey, you'll take it. So you look at this. This is actually another good sign. Their debt is down nearly over 10% year over year to $4.18 billion. So they're paying off a lot of debt, and they have cash on hand of $471 million, but that's because they're paying off their debt so much. And we can also look at their retained earnings. It's actually up 20% year over year. So FMC is retaining some earnings, so that's a good sign. But yeah, $471 million of cash, which is down year over year, but that seems to be like what it is in line with historical norms. So yeah, that's kind of my thoughts on FMC. Again, they're not diluting you as a shareholder, but they're not really doing any share buybacks either. But hey, right now could be a good time for them to do share buybacks if they can, if inflation comes back with their fertilizers or whatever. Again, not a super attractive industry, kind of like Google and Nike. I do like those two stocks as I own them. I'm probably biased on them. But yeah, those were the 5 stocks that were undervalued according to Morningstar. Let me know if you like how I do my own little analysis on them. So I show you the numbers for yourself. You can kind of draw your own conclusion. But yeah, don't forget to drop a like on the video. And if you leave a comment, I will respond to every single one of the comments. And I hope you guys have a great rest of your day.